That small purchase you repeat every day feels harmless, almost invisible, but over time it quietly compounds against you, draining future wealth in a way your brain never flags as a problem. Every morning he wakes up, checks his phone, and heads out the door following the same routine he's built over years, comfortable, predictable, and never really questioned. On the way to work, he stops for coffee and a quick snack, telling himself it's just a small reward, something he's earned for staying consistent and showing up every day. Weeks turn into months, and months into years, the habit repeating without interruption, small amounts spent daily, never large enough to feel like a real financial decision worth reconsidering. At first, nothing feels different. His lifestyle stays the same, but slowly, without noticing, his savings plateau, opportunities shrink, and the gap between effort and progress begins to widen. And this is where the shift happens, because what looks like a simple routine is actually part of a larger system, one that quietly determines whether wealth grows, stalls, or disappears over time. Welcome to Line Invests. This channel is about understanding how markets really work and how to make better decisions over the long term, because successful investing isn't built on predictions or shortcuts. It's built on structure, patience, and managing risk effectively. In this video, we're going to explore the math behind why most people never build wealth and break it down into something practical. Most people believe wealth is built through big decisions, promotions, or sudden opportunities, but in reality, it's shaped by small, repeated actions that compound quietly in the background over long periods. Here's what most people don't realize. Money doesn't just grow when you invest, it also compounds negatively when it's consistently removed from your future through daily, unexamined spending habits. At first, $10 doesn't seem significant, it feels too small to matter, but when repeated daily, it becomes a system, one that redirects capital away from growth and into consumption. Over 1 year, that $10 habit becomes over $3,000, a number that still feels manageable, still easy to ignore because it accumulated slowly without triggering urgency. But over 5 years, the pattern becomes clearer. That same habit now represents over $15,000, not including what that money could have earned if it had been invested. This is where the difference becomes clear, because money isn't just about what you spend, it's about what you lose the chance to grow. And that's where opportunity cost quietly expands. Instead of being spent, that same $10 per day, if invested consistently, begins to compound, not linearly, but exponentially, creating growth that accelerates over time rather than staying flat. In the first year, the growth feels small, almost disappointing, but this is where most people stop because the brain prefers immediate reward over delayed, invisible progress. This is a classic habit loop: cue, routine, reward, repeated daily, reinforcing behavior that feels good now, while quietly trading away outcomes that only become visible years later. Over 10 years, the invested version of that same money begins to separate dramatically from the spent version, creating a widening gap that feels sudden, but was built slowly. At this stage, the person who spent daily sees stability, while the one who invested begins to see momentum, not because of effort, but because of consistency and time working together. And over 20 years, the difference becomes almost unrecognizable. One path leading to financial pressure, the other to flexibility, all driven by decisions that once felt too small to matter. This is the core math behind wealth. It's not about intensity, it's about direction. Small daily flows of money, either moving toward growth or being absorbed into consumption. Another factor most people overlook is inflation, which quietly reduces the value of money over time, meaning that not investing isn't neutral, it's actually a slow loss of purchasing power. Over decades, inflation compounds just like investments do, but in reverse, eroding value, making future expenses higher while stagnant money struggles to keep up with rising costs. So when money is spent instead of invested, it's not just gone, it's also losing the chance to outpace inflation, creating a double effect that weakens long-term financial position. Here's what most people don't realize. Markets reward time more than timing, meaning consistency matters far more than trying to predict perfect entry points or ideal conditions. Behavioral economics shows that humans are biased toward the present, a concept known as present bias, where immediate rewards feel more valuable than larger delayed outcomes. This is why small spending habits persist, because the brain discounts the future, making long-term gains feel abstract, while short-term comfort feels real and tangible. Over time, this creates a pattern where income increases, but wealth does not, because higher earnings are absorbed by slightly higher spending, maintaining the same financial position. This is often called lifestyle inflation, where improvements in income lead to proportional increases in consumption, preventing the surplus needed for meaningful long-term investing. The system becomes self-reinforcing. More income leads to more spending, which leads to less investing, which leads to slower wealth growth, creating the illusion of progress without actual accumulation. And at first, this doesn't seem significant because everything feels stable, bills are paid, life continues. But beneath the surface, the math is quietly working against long-term financial freedom. Over the next few years, this pattern becomes more defined, income rises gradually, but so do expenses, and the gap that could have been invested never fully appears, keeping wealth growth consistently delayed. Here's what most people don't realize. Wealth isn't built from what you earn. It's built from what you keep and consistently direct into assets that can grow over time. At first, increasing income feels like progress, but without a change in behavior, the additional money simply flows into upgraded lifestyles, subscriptions, and conveniences that quickly become normalized. This normalization is powerful because once a higher standard becomes routine, it no longer feels like a luxury. It feels like a necessity, making it harder to reduce spending later. Over 5 to 10 years, this creates a hidden ceiling where, despite earning more, the ability to invest remains limited, preventing compounding from ever reaching meaningful scale. Meanwhile, someone with slightly lower income but stronger allocation habits may build more wealth simply because their system consistently feeds long-term growth instead of short-term consumption. This is where the difference becomes clear, because wealth is less about how much flows in and more about how much is allowed to stay and multiply over time. Another overlooked factor is time delay, because the results of financial behavior don't appear immediately, making it difficult for the brain to connect cause and effect in real time. Spending today feels harmless because the consequence is delayed, often by years, while investing feels unrewarding because its benefits are also delayed and invisible at the beginning. This creates a psychological imbalance where the brain consistently chooses the option that feels better now, even if it leads to weaker outcomes in the future. Over 10 years, this imbalance compounds into real differences, not through dramatic events, but through thousands of small decisions that quietly shape financial trajectories. At this stage, many people begin to feel stuck, working more, earning more, but not seeing proportional progress because the underlying system driving their money hasn't changed. This is where the concept of automation becomes important, because relying on discipline alone often fails, while systems can enforce consistent investing without daily decision-making. When money is automatically directed into investments before it can be spent, the behavior shifts, not through willpower, but through structure that removes friction from the right actions. Over time, this creates a reverse effect where spending becomes what's left over rather than the default, allowing investing to become the primary flow instead of the secondary one. In the first 1 to 2 years, this change still feels small. Balances grow slowly, and the difference isn't dramatic, which is why many people underestimate its long-term impact. But between 5 and 10 years, compounding begins to accelerate, and this is where the curve starts to bend upward, creating growth that feels disproportionate to the effort applied. And over 20 years, the results become significant, not because of large one-time decisions, but because of consistent, repeated allocation that allowed time to do the heavy lifting. Here's what most people don't realize. Compounding is less about returns and more about duration, because time is the multiplier that turns small inputs into large outcomes. Missing the early years of investing doesn't just delay growth, it reduces the total compounding window, which has a much larger impact than most people expect. For example, starting 10 years later doesn't mean ending with slightly less. It can mean ending with significantly less, because those early years carry disproportionate weight in compounding systems. This is why small habits matter so much, not because of their immediate effect, but because they determine whether time is working for you or quietly working against you. Over decades, this difference defines financial outcomes. One path leading to optionality and control, the other to continued dependence on active income and limited flexibility. And importantly, neither path feels dramatically different in the short term, which is why the distinction often goes unnoticed until much later in life. This delayed visibility is what makes the system so powerful, because by the time the outcome becomes obvious, the underlying behavior has already been repeated thousands of times. So the real question isn't whether someone is making big mistakes, it's whether their daily patterns are aligned with long-term growth or quietly pulling them away from it. Because in the end, wealth isn't built through intensity or occasional effort. It's built through systems that consistently direct money toward assets that can compound over long periods. And once that system is in place, the process becomes less about constant decision-making and more about maintaining a structure that allows growth to continue uninterrupted. This is where financial progress starts to feel different, not because income suddenly spikes, but because the relationship between time, money, and behavior finally begins to align. And that alignment, built through small, consistent decisions, is ultimately what separates those who struggle to build wealth from those who allow it to grow steadily over time.